Hey, welcome to the Money Morning Podcast. My name's Lachlan Tierney. I write for Money Morning and I also do Exponential Stock Investor. But today's focus is on gold. I have a seriously bright gold expert on today. His name is Tekoa Da Silva. I've got a lot of admiration for his style of communicating important information about gold. He used to run a popular website called Bull Market Thinking. And he was also working for Sprott Global Resources as an executive director. I think you'll find this really interesting. And to give you a bit of context, I've got Brian Chu on today as well. He does Rockstock Insider and Gold Stock Pro. I'm very excited to have this chat. Brian, how's it going there?
Yeah, I'm good. Thanks, Lockie. And yeah, I'm looking forward to this interview.
Well, we've got a heap of good gold content for people today. Let's get stuck into gold, Brian.
Yep, let's do it. So, Tekoa, can you share with us your experience in the 7 years at Sprott Global Resources, and including some of your most interesting transactions in that period?
Sure. Yes. Well, just for context to the experience, very wonderful educational experience, and over the course of that 7 years, I probably sat through anywhere from, it might sound like a lot, but anywhere from 500 to maybe 750 presentations by resource companies, most of them juniors, exploration development stage companies. And so that it was a very educational experience to do that. And I played a role in probably about 100 private placements. So super educational. As a specialist natural resource firm, it's a wonderful place to learn about the natural resource sector, that firm. So some of my most memorable transactions that I experienced, I would say were open market deals. Some people could refer to it as the secondary market, and that is just the open stock market where you can buy or sell shares at any time. Although I saw a lot of interesting situations that came up by private placement, it was a couple open market situations that really stood out. And a couple that come to mind are one company called Corona Gold, another company called First Mining Finance, which today has a different entity name, and as well as a company called Ivanhoe Mines. And so I had a wonderful experience with each of these three issues. And so going back to Corona Gold, this was an issue that I'm not sure if I had had the opportunity to have any writings on this issue cross your desk, Brian, back in the early days of 2013 and 14. But this was a company that, I was fishing through the annual report of Dundee Corp, which is a Toronto-based natural resource and a merchant banking group. And I was fishing through their annual report, trying to find good leads for investment opportunities, other companies that I could buy shares in and such. And I came across one that they had a very large ownership percentage in, and that was an entity called Corona Gold. So then I pulled up the annual report of Corona Gold, and I found that they had about 11 million in cash, we'll say Canadian dollars, and then they also had a stock portfolio that was worth about 11 million Canadian. That was measured against a market cap that was about 10.5, maybe 11 million Canadian. So when I looked into the company a little bit more, I found that they weren't very active in terms of any exploration or projects or anything like that. It was just sort of a quiet, dormant shell company that occasionally engaged in private placements in other companies. And so that was my introduction to the term net or a cash box. So a resource cash box is just a little entity that some specialist firms, let's say a natural resource firm, someone deeply entrenched in the sector might have a few of these entities on tap that they could use at any time to do transactions with. So a cash box is sort of a jargon term used to describe one of these entities that is already publicly listed with cash, with some other kind of asset that just kind of sits dormant. And so, and that's also, or that leads me also to mention net too, because when you look at the market cap, of a company in that situation, what you can do is you can take a look at the balance sheet, and the balance sheet is where they show the assets and the liabilities. And I was just new to that exercise at that time, but I took a look at the balance sheet and I looked at the cash and the liabilities. I subtracted the liabilities, and then when you subtract the market cap from that net cash balance that remains, you have what is a net cash balance that the shareholders own. Then if you divide that by the outstanding number of shares that exist for the company, you can get an idea of how much net cash per share exists. And if that amount is higher than the share price, that it could be an interesting situation to look closer into. So I got involved there with Corona Gold, and it was a very sleepy experience for about 2 years. Nothing happened. I talked to a couple of people about it, and they said, and this is what most people say when you have neglected situations, is they say, nobody cares about it. It's a forgotten story. This can go wrong. That can go wrong, even when the mathematical setup is really attractive. And I remember someone posing the question of, well, they have all that cash. What are they going to do with the cash? They're probably going to spend it on something stupid. So that was the type of sentiment that I was encountering. But I stuck with it. And what happened later on was a consortium of companies got together and announced a 5-way combination. And it was Corona Gold and a handful of other companies, and the Corona Gold shareholders enjoyed a nice takeover premium. And this also brings to mind First Mining Finance when I suggest that back in 2014, 15, and early 2016 in the natural resource market, when there were M&As happening, there were pretty big gaps available that could be exploited as arbitrage opportunities, because you'd have an acquiring company make an announcement of a takeover, and then the acquiree might have a very small bump in price, but there would be a big gap between what the transaction price would be and what the trading price would be for the acquiree company. And a person could say, well, the marketplace is very skeptical that a transaction is going to take place. They think it's not going to take place. But in a marketplace where you have few participants and poor sentiment and cynicism, those gaps can be quite large. And I remember that Corona Gold at that time, it still had something like probably a 30% arbitrage gap that could be captured. So I remember participating in it that way as well. And then that it became Oban Mining after the transaction closed, and then Oban Mining became Osisko Mining, and Osisko Mining is still around today with a larger portfolio and development stage assets and such in Canada. So that's one transaction that comes to mind, and it was fun for me because it was so educational, and I learned for the first time that process of what is a cash box, a resource cash box? What is a net, and then to actually do it and put it into practice was very nice. Another situation comes to mind, and that is playing a role in the First Mining Finance, the pre-IPO private placement that they had. And I think this was January or February of 2015. And so their intent with that vehicle was to become a consolidator of gold development stage projects, become a bank, if you will, of lots of gold ounces in the ground. I remember that placement did not include a warrant. It was just a straight, single common share. So that wasn't very remarkable that the terms of the private placement didn't didn't really stand out. But what was remarkable for me in the experience was the following year and a half of participating in that entity, and that was they went on a real shopping spree. They did probably 6 or 7 acquisitions in I think 2016 alone. And on nearly every single one of these acquisitions of a public entity, there were these big arbitrage gaps that you could capture. So I remember talking to people at the time that, were long First Mining Finance shares. They would announce their next acquisition, and the share price, the premiums that were offered were anywhere from 30 to 60%. But oftentimes the share price response of the acquiree company would only be a few percentage points. So it might move up 5% when there is actually a 50 or 60% premium that was offered. So a person could continuously take their First Mining Finance shares after, I'm leaving tax consequences out of this statement, but they could repeatedly take their First Mining Finance shares and after each acquisition announcement, sell them out and use the same funds to purchase the equivalent dollar amount of shares of the acquiree company, wait till the close, receive a larger number of First Mining Finance shares back, post-close, and just keep rinse, wash, repeat this process over and over. And I saw a number of people do that, and it was quite enjoyable. And there's also a book, if anybody wants to look it up, there's a book that talks about M&A and arbitrage. It's a book that I think it's called Warren Buffett and the Art of Stock Arbitrage, written by Mary Buffett. It's a very simple book, but it's a great foundation if someone wants to learn about that practice for the first time. So a third transaction that comes to mind that was very educational for me was watching the Ivanhoe Mines experience of how they went through a real awful bear market for the 3-4 years leading up to 2015. And they had a bottom in their share price in January of 2016. And I remember talking about it with my former boss at the time, a mentor, Mr. Rip Rule, and remarking about how they were in a net situation, that company as well. The share price of the company was fluctuating between 50 to 65 cents Canadian, and they had something around 70 to 75 cents Canadian per share net cash in the bank in their corporate treasury. So what you would get by buying that company was a slight discount to the cash, and all 3 of their world-class projects covering platinum, zinc, and of course their ocean of copper in the DRC, you would get all those projects for free within the valuation. And it was so funny. I remember talking with people about it at the time, and as an indication of sentiment at the period, people, they would say, well, I'm just not bullish on copper at the moment, or I don't like Africa. And I would think to myself after, talking with people that to use an objection such as you don't like the country very much where the company or the asset is located in is a very unique objection, because it almost implies that the person that you have to move there and live there in order to invest there. That was what was going through my mind. But what can you say? That type of sentiment just accompanies those periods of time. And fast forward to today, and the price of that stock, Ivanhoe Mines, is north of $9 Canadian per share. So that's almost a 20-fold increase in price for that one. And Corona going into Oban, going into Osisko did fairly well too. And that entity that First Mining Finance converted into, I think called First Mining Gold, I think that one has done fairly well over time too. So those are a couple of my favorite transactions that I experienced, and they were mostly open market situations as opposed to the private placement situations.
Hey, can I step in and ask you a question, Tekoa? I think that's really interesting, that sort of net valuation metric you mentioned. For example, I focus on small caps quite a bit, some in the commodities area, but what I often do is look at cash balance sort of relative to where that company is at its life cycle. And that's particularly useful for growth or tech companies, I've found. But I was hoping you could tell us a bit more about the net system that you use, because I know Brian is really into valuation metrics when he approaches gold stocks.
Gosh, after I had that experience, I was thinking to myself, I want more of these. After I had that experience with Corona Gold, and I thought, well, how am I going to find these? And I did it probably the dumb way, or the hard way at first, which was I went on to CDAR, which you may know. It's in the U.S. they have a system called EDGAR. In Canada they have a system called CDAR, where it's just a filing system where all the publicly listed companies will submit their all their public announcements, their quarterlies, their annual reports. And I started going through there one at a time to every single listed company, their financial statement, pulling up their balance sheet and just doing the quick calculation on paper or with a calculator. That was the hard way, and I thought that was, gosh, I was so naive to think that that's the only way to do it, because as you guys probably know, you have screening systems now that can do that. But so that's what I did. I probably did that a couple thousand times, embarrassingly enough, and I came across one or two, but they didn't have. I found that what was more attractive was when you found a net situation where the cash balance was enormously large. Because if you have a net situation where, let's say, the market cap of a company, of an exploration company, is 3 million, and they've got a net cash balance of 5 million, as you guys know, in the corporate world, that cash disappears in a flash. It just, especially if they're an active exploration or development stage company, that it can't even really be relied on, because that might be 1 or 2 years worth of operating funds. So it has to be a large amount of cash. And so I discovered that you can use a couple screening systems, such as Bloomberg Terminal or Thomson Icon. And you can set up your parameters of, say, looking for a company that has a market cap of, or let's just say, a cash balance of 20 million or more within a specific sector, let's say metals and mining. And then, so a cash balance of 20 million or more with a market cap of, let's just say, 50 million or less. And you hit enter, and that'll give you a prospecting list of probably, well, these days I don't know, because it's been a while since I've run these, but you'll get a prospecting list of maybe 30, 40, or 50 companies. And then you just go through them one at a time, slowly, and you'll come across the odd situation where, and I can go on if you'd like, where this led me into running screens on other countries around the world, which is what led me to emerging market regions. But that can be an efficient way to do it. Does that answer the question?
Brian, do you want to jump in?
Yeah. Yes, that actually did answer the question quite well, I think. And what I liked was that, Tekoa, you actually went through these companies in your early stages by hand. I think there is nothing that can substitute getting a screen, like getting a program to do the screen for the companies, because it is when you're pouring through some of these financial statements that you start picking up subtle details about whether a company is worth investing in or not. And a screener may actually kind of skip through that. And once you develop that experience, which you certainly have, then using these screens might save you a bit of time. I personally have a gold producer database where I actually keep accounts of the financials, the resources, and the production metrics, and I actually hand collect those. There's about 25, 26, 30 companies in my database, and spanning back about 2012. So yeah, that's actually something which I think is very good practice for someone who's serious about the markets. Now, going back to what you talked about in those transactions, your favorite transactions, I noticed that most of them were in 2014, 2015, in the market where it was starting to pick up. And fast forward now, you can see that we had another rally in the price of gold in the last 2 years, and the last 12 months have been, you could say, a little punishing for those who just jumped in that rally of 2019, hoping that this was going to go a long way. What types of opportunities do you now see in the mining industry, especially in gold, and which regions would you consider best value? Is it similar to your experience when you first started at Sprott Global Resources?
Well, Brian, that's a wonderful question, and I I feel like I might be a little bit of a letdown to this question to you and possibly the audience, and that is that I've been led to a different area these days based on my experiences and having run these screens so many times over the years from 2015 up until the present. And in thinking about us having this conversation, I thought, how would I characterize or in chronological order the years from 2015 up until the present? Because the most transactional fun I had was really during that bear market period of 2015 and 16, because you get these situations that come up that people, things are so good that people have a hard time believing you. And so you feel like, well, you're a kid in a candy store, so to speak, and nobody cares, and you feel like you're sort of the only one. We'll have those times again, I just don't know when. But what I noticed was that as each year went by from 2016 to the present, there were new waves of investors coming into the sector. The newsletter writers played, I think, a very good role in terms of promoting and marketing the sector. And it every time we had a little bit of a pickup in price, I remember observing signs of groups of new people, many of which had never invested in stocks before, starting with metals mining, gold mining, as a starting platform, which is a pretty unique way to do it. So, from 2016 into 17, as the sector started to really recover, I was running these little net screens, and they were getting smaller and smaller, and these situations were disappearing. And I thought to myself, well, wait a second, how can I find more of these? And so I opened up my search criteria a bit to include other countries. And I started looking at Asia. I looked at Australia, of course, the European countries. And places like, I started changing my search criteria a little bit and exploring ideas such as big, strong, mature companies that might be selling for a fraction of the price to book ratio, or let's say 20 to 30 cents on the dollar when you look at price to book. That's a different way of looking at discounting value, as that price to book ratio is not always applicable with, for resource companies, because they're just a little bit of a different animal. But so I got to looking at that area. Okay, so I thought, well, wait a second. I read a wonderful book called Snowball, talking about Warren Buffett. I think it was Alice Schroeder who wrote that book. And Warren Buffett in that book told the story, I think, to the author, where he said, I purchased back in some decades ago a basket of South Korean stocks that were trading at between 2 to 4 times earnings, 2 to 4 times PE ratio, plus they were also selling at a discount to cash, which is that's insane. It's like buying a laundromat for $100,000, and the laundromat business produces a net income after all expenses have been paid of $50,000 a year. So you have a 2-year payback, and then the business account of the laundromat also has $120,000 sitting in it. So you pay 100, you get 120 back, and then you get a 2-year payback relative to the price. that's the situation. And so I was running screens, and I was getting feedback of places like Russia. I was starting to get results for places like China, and I noticed that it was the emerging market countries that were not as much like, let's say, allied countries of the Western developed countries that had cheaper equity markets. And so I spent more and more time there. And I began to find net situations. As an example, a shipping services company. The situation still exists today. Anybody can go look it up. Costco Shipping, Costco Shipping International, Hong Kong, and I think their symbol is 0515.HK. You probably know that one. So that's a situation where they sell at a discount to the net cash on hand. The discount got to as great as about 30 to 40% discount to net cash. This was some months ago in 2020. But on top of that, they have an income producing business that for a decade plus has been paying consistent, steady dividends. It's like a shipping services company. They paint and wash shipping freights with the shipping containers, sell insurance, parts, repairs, all that kind of stuff. So I was coming across situations like that. And then what I started to notice after the Trump presidency in the US was that he started intensifying the trade war language with China going into 2017. I was very interested in the country, so I went to go visit it, and I went to go visit some publicly listed companies that were there too. And I had a spectacular experience. What an amazing country, I have to say. And but what I noticed was that in these valuations that I was coming across big, mature, blue chip style companies. Like if you could imagine, like the McDonald's, the General Electrics, the Goldman Sachs of the West, of the U.S., but the equivalent companies in their country, we'll call them red chips, I guess, to use one of the Jim Rogers, terms. I noticed that they were selling at price to book ratios of 0.5, 0.6, 0.7, PE ratios of 7, 8, 9, 10. And I thought, okay, well, that's okay. But these Russian companies are selling for 2.5 times earnings, 3 times earnings. When you look at something like Gazprom, just extraordinary. But I was watching the situation from 18 into 19. So it started with the trade war. The trade war language got really, really tough. And then in 2019, the fall of 2019, that was when the COVID situation started coming out, as our viewers know here, with China. And then their stocks got pounded again from October into January. They just, maybe pounded is not the right word, but they just kept drifting lower. So this was a solid 4 years of continuously lower drifting prices. And then when we had March of 2020, their shares also plunged. Coming out of the March 2020 bottom, the U.S. market and Western markets surged. The U.S. market, of course, has moved up, I think, maybe the most of all the countries. But these Chinese companies and the Russian companies, to an extent, they recovered a bit. But now over the last between October and November, when they last made the bottom, their energy shares, they're now getting back to where it looks like they may retest the October-November lows. And the October-November lows for many of these Chinese stocks were lower than the March 2020 lows. And so the kinds of stocks I'm talking about are banks, oil, energy companies, oil and energy service companies, big engineering companies, the state-owned entities in particular, textile companies. So that's what I'm looking at today. I've got big lists of companies where I can put together a portfolio of 30 to 40 of the strongest companies within a particular region, let's say Russia, China, or parts of Africa, and the average price to earning ratio across a portfolio could be 4. The dividend yield is between 6 to 8%, and the price to book 0.25 to 0.6, 0.7. So I know that that's a little bit of a walk away from natural resource exploration, development stage project investing, but that's where studying the work of, Ben Graham and some of the other value investors has led me. So I hope that answers the long-winded way to answer your last question.
Hey, I think Brian's got a really exciting question for you coming up, but I just want to ask you a sort of really broad question here. You talk a lot about value, price to book, dividend yields. The ideal situation is where you have a sort of net or high cash to market, or like 1-to-1 cash to market cap ratio, and then you get value, growth, and a dividend. That's like the holy trinity. So I was just really wondering, do you think everyone talks about the value growth dichotomy? The ideal situation is you find a value company that turns into a growth company, and it's sort of like a post hoc explanation of what happened, when really what you're doing is looking at screens or stock screeners. You're looking for certain gaps or arbitrage opportunities. I think what investors would really want to know is sort of, is value growth a false dichotomy, or by that do I mean, like, if you find a really good value company, it could then be considered a growth company once the market wakes up to it. Growth companies are generally considered, oh, the line's going up, it's a growing company. So I was wondering if you could talk a bit about that and provide a bit of context for investors.
Yeah, Lachlan, that's such a good question, because it's such it's a gray area, and the area, it moves, and it means different things to different people, because and this is a wonderful discussion of what is investing and what is speculating, and what is an investor and what is a speculator. And it means different things to different people, and that's okay. So I think it's up to each individual person to explore those two terms and decide on a meeting that is suitable for them. And one of my favorite places to go to explore those two terms a little bit, I'm sure there's some work on it in The Intelligent Investor, but I can't quote any specific passages today. But in Ben Graham's security analysis, let me see here, in chapter 4, distinctions between investment and speculation. And let's see here.
I can't believe you've got this book handy.
Yeah, discrepancies between price and value. That's chapter L at the end of the book. But if you were just to explore, I mean, this book is kind of difficult to get through, especially for a layman who's new to the material. But just those 2 chapters are very easy to read, and if someone starts there, it's extremely helpful, I think, because so to your question. Well, I'm reminded of that situation of seeing Ivanhoe Mines back in 2015. Is it a growth company? Is it a value situation? I think it depends on how you were to look at it at the time. And the way that I've concluded on looking at certain things is, or looking on this thing, is that most businesses have speculative upside. There are things that happen. The ebb and flow of any marketplace causes some businesses to expand, contract, go through fat times, go through lean times. And the lean times, your competition gets run over and they disappear, and then you have the fat times return, and then whatever business they're in gets to enjoy the speculative upside that is available to them because their competitors are out of business. So I have thought about this, and I thought it's extremely difficult. It's like this patience-trying exercise for a person to want to do, but that is to look at situations and say, well, this business may have a lot of growth upside, or I would call it speculative upside. Let me see if I can buy it at a value style valuation and get the growth for free, or get the speculative upside for free. And that's exactly what a person was doing by buying Ivanhoe at a discount to net cash, is they're getting all the speculative upside, which is copper pricing, rebounding in the copper market, as well as zinc and platinum and palladium. They were getting exploration upside for free. And so, and I've seen that in lots of other situations. Another one was Africa oil. That one I think is still extremely attractive from a valuation standpoint, but it's not a net situation today as it was in 2017 when I started getting involved with it. You had the situation where you were buying the company at a cash valuation, and you are getting their exposure to this oil deposit that had estimated somewhere between 750 to 1 billion barrels of oil in the ground. You're getting exposure to that for free. So you are getting the speculative, the growth aspect of it. If exploration would cause the deposit to grow, that I suppose that would be growth. You are getting that aspect of it for free, as well as commodity price recovery in terms of if the price of oil or other energy products were to sharply recover, you would get that part of it for free. So, but that's such a good question that I hopefully answer it.
Oh no, that makes perfect sense. It's about getting that speculative upside for basically for free. And if you can manage that, you're in the sweet spot as an investor.
Yeah, it's one way to do it, but those situations don't come around every day. Or you have to be looking in sort of these disparate areas that not too many other people are looking in or don't want to look at, kind of thing.
And that's where people like Brian come in.
Yeah, that to a certain extent, I can try and do that, but Tekoa is right. It is not so easy to find companies that are in net situations, even with Australian listed speculative explorer stocks, because I think people have warmed up to the idea that there is a gold rally and they want to position themselves in it on the ASX. And I was going back to what Tekoa was saying, in that there are all these opportunities in China and Russia, because a lot of these companies are trading about 50 cents to the dollar in price to book value ratio. I remember I was teaching international students in a couple of years ago, and I saw some of them actually playing with the stock markets while in class, and I don't mind them doing it as long as they do their work. So I asked one of them, do you actually do much fundamental analysis as in looking at the financial statements? And one of them smiled in a really, it was a really wry type of smile, and it goes, there are two sets of accounts in China, in Chinese companies. There's the ones that come publicly, and they're the ones that they actually have. And I kind of tapped my nose, and I was going, okay, I'm not sure though, from your experience, Tekoa, is that the case? Do you think that there may be potentially two sets of accounts that are out there?
Oh, sure. Yes, that's absolutely the case. And there's no way to know. International investor Mark Mobius was once asked in an interview how he were to keep tabs on untrustworthy managements, especially in emerging markets, such as I think what was Turkey, what was being asked of him at the time. And he said, well, if a management team wants to steal from you, they can find a way to steal and keep it completely secret. So it's a very difficult thing to get a handle on, and discovering who or the character of any one person or one specific team, unless somebody has a really talented gift of being able to spot that right away. Sometimes it could take years to do that, to being able to uncover, demystify those frauds. And so that's not an area that I have, or I think I really want to develop any skill in, just because it seems like such a difficult thing to do. But I came across a passage at one time, I believe, in reading Graham's work, where he pointed out that that may be a bit of a more uncommon phenomenon for those to occur. But something did strike me, and that to this question is, I think that there is a likelihood that there will be a higher probability of fraud occurring in hot markets, ebullient markets, where the share pricing of lots of different companies are just going through the roof because fraudsters are short-term oriented. I don't know of any fraudster who might think, or I wouldn't imagine any fraudster would think to themselves, well, if I work really hard for 5 or 10 years and I present a really honest and trustworthy picture of myself, on the 11th year, I might be able to dupe somebody out of a few dollars.
What about Bernie Madoff? Except he didn't
Sure.
defraud them for $2. Say that was billions of dollars. I guess that's a different story.
Sure, yeah. But one thing that I've noticed is that these value situations that we've been talking about so far, they usually occur in the context of either extremely sharp declines in markets or extremely protracted declines in markets, where a market's been declining for, in the case of Russia, China, and these other African markets that I've been looking at, they've been continuously declining since 2007. They had a little bit of a recovery from the 08 to 09, the 09 bounce coming out of the financial crash, but they just resumed their downward decline. So they've been continuously declining for 14 years. And I think that you'd have a higher likelihood to encounter teams that would have funny business going on in hotter markets, say Western developed, maybe US markets, than you would in some of those other markets that have had continuous 10 to 15 year bear markets, because so many companies are just squeezed out. People throw in the towel and they want to go to where, quote unquote, the money is. I hope that makes sense.
Well, everyone wants to get in before the market gets hot. I think Brian has one last question, probably about gold and whether there's a value opportunity here before it gets hot again. So Brian, go ahead.
So Tekoa, there are a lot of people who jump into speculative mining stocks because they think this is the quick way to get rich. But what would you advise them to do to increase their chance of success?
Well, I would think about exploring the terms speculator and investor and speculating and investing. The best place to do that would be starting with The Intelligent Investor, reading that book, and then looking for those two passages that we mentioned in security analysis, really giving that thought. And also, if they're going to enter the natural resources space, I'm not sure if we have time for it today, but there is this a concept that they could think about called the 4 asset classes of mining, where they can decide what segment of the natural resource space they want to specialize in or to cut their teeth in. So that could be a major producer, a junior development stage company, or a junior exploration stage company. And each of these 4 groups have subcategories to them. And there's lots to learn about each one of them. So I would suggest thinking about that and following your work, Brian, to learn as much as possible. And maybe, I don't want to suggest too much time, but my first thought is to spend a couple of years learning about this stuff and learning as much as you can, and maybe experimenting with very small amounts of money before moving on to more substantial amounts. And I would also say that every 10 years, we get a very nice bear market in the natural resource during the years that I've been observing it. So that's what I would suggest to somebody that's new and wants to learn more.
Hey, just on that theme, Tekoa, I've got one final punchline question for you, and that is, what do you love the most about your work? I think it's education based on what you've just laid out for us. I think there was a lot of detail there, but how do you have fun in your work?
Well, getting something for free to me is fun.
Everyone loves that.
Yeah, yes. And sharing it is fun, being able to talk about it. But it's just finding a nice bargain, and it gives me. I enjoy the same feeling as if I had gone to a yard sale or to some store, and having been the only person to notice that there's a little clearance section hidden in the back with goods that are between 70 to 90% off that the store owner has to get rid of that day, and you can make a little offer and take the whole thing home. There are situations like that in the market, and so that I think is where I get the most fun out of it.
Hey, I think everyone can relate to that sort of experience and feeling. So at the end here, I just really want to thank you so much for your time today, Tekoa. People watching and listening would have learned a heap, and I had a lot of fun. Do you have any thoughts, Brian?
Tekoa, what you were saying about how new speculators need to actually do a couple of years and study it, that's actually really true. And your website back then, Bull Market Thinking, actually allowed me to remind myself that success doesn't come quickly, and you really have to be patient about it and stick to your guns. So I really appreciate the time you've given to us for today. And I'm sure the viewers would definitely love to have you come back, as there was a few things that you talked about, which you said we didn't have time to get into details, so we could probably do that in a future interview. So thank you very much, Tekoa, and I hope you do enjoy your evening as we've taken a bit of it out for this interview. My appreciations on behalf of the viewers.
Hey, it's my pleasure. Thank you very much for the opportunity, Brian, to speak with you, and you as well, Lachlan. Thank you, and to the viewers, subscribe and get all of Brian's work. And if you watching, if you have any ideas or questions or things that you want to ask, send Brian an email, and he and I will find a way to get the information to you. So thank you.
Wow, that was a great chat we just had with Tekoa Da Silva. I was really curious as to what you thought of that chat, Brian.
Lockie, I thought Tekoa spoke at length on several issues, which I would probably think that it would be subscriber content, but he didn't. I won't say he gave things away that he shouldn't, and I'd love to have him back to talk in more detail about other issues that we didn't have time to cover.
Well, I think anyone who's serious about gold and commodities, Tekoa and Brian are great guides here. So I'd really encourage people to check out what they do. As always, like, subscribe, get in touch. We'd love to hear from you.